Hey everyone, welcome back to Corporate Decoder. Today, AIAI Holdings Corporation, II, just filed its quarterly report. The 10Q and I am seeing some massive shifts since their big acquisition event. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company made a huge splash with its acquisitions earlier this year, and now we are starting to see the combined financial picture. This report covers the period ending the 30th of June of 2026. Right off the bat, we see the company is listed as a non-accelerated filer and an emerging growth company, which tells us they are still in the early stages of their public company journey. They have over 70 million shares outstanding. Now let us dive into the numbers and see how the combined entity is looking. On the asset side, we see cash and cash equivalents of about $11.2 million. They also have significant contract assets, which are basically payments due for services rendered, but not yet billed, totaling over $41 million. What is really striking is the jump in Goodwill to over $305 million and intangible assets, now standing at over $644 million. This reflects the massive acquisitions they made earlier in the year and how they are valuing those acquired businesses and the intellectual property like their AI technology. On the liabilities side, we see total current liabilities at around $108 million and total liabilities at over $317 million. This includes a significant amount of contingent consideration, which is essentially an estimated future payment based on performance, a whopping $20.6 million. Looking at the income statement, we see total revenue for the period May 7th to the 30th of June of 2026 was about $39 million. However, their cost of sales was nearly $34.3 million. This leaves them with a gross profit of only about $4.8 million. What is really eating into their bottom line are the acquisition and related costs, which clocked in at over $20.5 million. This is a direct consequence of all those deals they closed, and it is a major reason why their operating loss for this short period was nearly $43.7 million. They ended up with a net loss of over $38.9 million for just that short period. The equity section shows a huge transformation. For the successor entity, IIE, they have over $1 billion in additional paid-in capital, reflecting all the stock issued for those acquisitions. However, they also have an accumulated deficit of nearly $47 million. This highlights that while they have raised a lot of capital through stock issuance, they are still operating at a loss. In terms of cash flow, their operating activities used over $11.8 million in cash during that same short period. Investing activities actually brought in over $13.1 million, primarily due to cash acquired in those business combinations. Financing activities provided over $9.6 million in cash. This section gives us the backstory. AIAI Holdings Corporation was formed specifically to build an AI-powered ecosystem by acquiring companies. They bought 6 portfolio companies on May 6, 2026, including CC Carlton Industries, known as CCCI, which is considered their accounting predecessor. Other acquisitions include Constellation Network, MediGuide, AI Research Corporation, Vanguard Health Solutions, and Bond Street Limited. They also entered into an AI license agreement with Messier 42 LLC, an affiliated entity. Their revenue comes from construction services, healthcare services, and technology products and services. Construction revenue is recognized over time as projects are completed. Healthcare services are subscription-based and recognized over time. Technology revenue includes hardware sales, digital asset rewards, and network licensing. They are actively involved with digital assets like DAG, LTX, USDC, and COTI. These are measured at fair value with changes impacting their income statement. They are also holding some crypto assets that are issued by their own network as indefinite lived intangible assets. This is where we get the details on the acquisitions. They acquired 100% of 6 portfolio companies for around $460.7 million in III class of common stock. The valuation of these deals is based on their initial stock price of about $15.09 per share. The acquisition of Bond Street was treated differently as a transaction under common control. The company recognized over $180 million in identifiable intangible assets from these acquisitions. This includes customer relationships, trademarks, software, and the AI technology license. These are amortized over their useful lives, typically ranging from 1 to 25 years. Here we see a breakdown of their revenue. Construction revenue makes up the bulk of it, coming from both public and private sector customers. Technology and healthcare revenue are much smaller portions. Looking ahead, they have about $186 million in future revenue from existing contracts. Most of that is expected within the next 12 months. Their property and equipment is valued at about $30.7 million. depreciation expense is relatively low. This section highlights several transactions with related parties. They have an AI license agreement with Messier 42 LLC for which they issued over 25 million shares of Class A common stock. They also have a technology services agreement with Messier 42 LLC where fees are waived for 15 months. There is also an investment in Messier Blocker Corporation, an affiliate and a founder loan totaling over $7 million. This shows a significant amount of business being done with entities controlled by the founder or affiliated parties. As of the 30th of June 2026, they held about $1.2 million in digital assets and $377,000 in restricted digital assets. These are subject to market volatility and some are pledged as collateral. This table breaks down their intangible assets, which are substantial, totaling over $644 million. The AI technology license alone is valued at nearly $467 million. They are amortizing these assets over their useful lives. They have operating and finance leases for office space equipment and vehicles. The future minimum lease payments are listed out. The company has granted restricted stock awards to employees and directors. The total unrecognized compensation cost is around $13.9 million, expected to be recognized over the next almost 3 years. Their debt obligations total nearly $38.7 million. This includes equipment financing notes, payable revolving credit facilities, and the founder loan. They have authorized millions of shares of Class A and Class B common stock. They issued a large number of Class A shares for the acquisitions and for the AI license and investment in an affiliate. The Class B founder shares give the founder controlling voting power. For the period covered by the report, they reported a loss per S-share of negative 56 cents. Management reiterates their strategy of acquiring companies and enhancing them with AI. They believe their accelerated AI implementation process is a competitive advantage. They highlight the transition to a new reporting entity after the acquisitions, and that the predecessor and successor periods are not directly comparable. They detail their revenue streams, construction, healthcare, and technology, emphasizing that construction is their largest revenue source. Management points to the efficiency of their AI implementation integration of acquisitions, weather impacts, seasonality, ability to win construction projects, and the price volatility of digital assets as key factors affecting their performance. They are also mindful of inflation and tariffs. They present adjusted EBITDA, which is a non-GAAP measure to evaluate their business. For the 3 months ended the 30th of June 2026, their adjusted EBITDA was negative $2.5 million. For the 6 months ended the 30th of June 2026, it was negative $3.6 million. This shows that even after adjustments for certain expenses, they are still operating at a loss. The company acknowledges material weaknesses in internal controls over financial reporting inherited from its predecessor CCCI. They are working on remediation efforts by engaging external consultants and developing comprehensive policies and procedures. This lists the exhibits filed with the report, including certifications from the CEO and CFO. Overall, this filing paints a picture of a company in a major transition. They have made significant acquisitions and are now grappling with integrating these diverse businesses and realizing the promised synergies from their AI technology. The balance sheet shows substantial assets primarily from acquisitions, but also significant liabilities and an accumulated deficit. Their operating results for the short period are heavily impacted by acquisition costs, and while they have revenue streams across multiple industries, the path to profitability seems challenging in the immediate future. The heavy reliance on related party transactions and the presence of material weaknesses in internal controls are also key areas to watch. What I am actually looking for is how quickly they can turn these acquired businesses profitable, and if their AI implementation truly provides the competitive edge they claim. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. The research tools I actually use are linked in the description. They help keep this channel going.